If there's one thing that's fascinated archaeologists over the years, it's the quality of the infrastructure of ancient civilizations. Indeed, the Roman roads still lie beneath the modern road network of the UK today. So one could sometimes be forgiven for questioning whether modern civilization has progressed that far since Roman times. In recent years, the opportunity for retail-oriented investment funds has certainly increased. Indeed, this has been one of the impressive success stories of the London-listed investment trust market in recent years. As I mentioned yesterday in an earlier introduction, we review our skill essentially to be to select good quality asset management teams to run the assets and the projects that we wouldn't have the ability or expertise to do ourselves. For many years now, we've been invested in an investment trust called the International Public Partnerships, or INPP. It's a bit of a mouthful. I'm delighted to introduce Giles Frost, the trust manager, Amber Infrastructure, who has been directly involved with the trust since it first listed in 2006. And indeed, today the trust announced its interim results, which were very strong and demonstrated good inflation linkage and participation. And as the managers of over £9 billion of infrastructure assets around the world, some of which are the most ambitious and impressive engineering projects on the planet, I can't think of a better person to give insight into this most fascinating part of the asset management industry. Over to you, Giles.
I want to talk a little bit about, obviously, infrastructure, which is where I spent my career working, and I thought I might talk first about infrastructure as an asset class and why I see it so attractive. My exam question was to also bring in the subject of inflation and how infrastructure can give a hedge against inflationary risk. And I thought I might finish in a few minutes by talking about some of the individual assets and sort of sub-asset classes we're looking at for the future, because I think that in a subset of investments such as infrastructure, one's always looking for the next area of kind of focus. So that's what I want to cover. So there we are. So I thought I'd start with some pictures. And the point of putting these pictures up really was to demonstrate that, as Richard said, infrastructure is by no means a new asset class. Infrastructure has become a kind of key part of many people's alternative asset strategies in recent years. But the original idea of using private capital to invest in infrastructure is by no means new. So the original canals and railways, turnpike roads, toll roads were all financed with private capital. So in some ways, the modern focus of the deployment of private capital into infrastructure assets is merely a recycling of an idea which was prevalent, up to a couple hundred years ago. And it's fair to say that infrastructure is not an asset class without risk, because those people who know anything about canal investment or railway investment in the 19th century will probably be aware that a lot of the first investors in those sectors lost their shirts. So we should bear in mind that, particularly if you're investing in infrastructure assets where you're taking full demand risk and you're taking a punt on how many people are going to use your assets, then there are real genuine risks, just like there are in any other business. But the renaissance of infrastructure as an asset class really, I would date to the 1990s. And in the 1990s, the UK government was trying to borrow less on the debt markets and came up with a concept which they called a private finance initiative, and is better known these days as PPPs, public-private partnerships. And the concept there was to get the private sector to develop new public and civic infrastructure, schools, hospitals, roads, those sort of things, using private capital, where the private sector would be given a brief as to what the government required, but actually the precise way in which it was delivered would be left down to the private sector, in return for which the private sector would get an assured RPI-linked cash flow for 25 years, with the asset reverting to the public sector at the end of that period. So it was and still remains in some ways a controversial initiative. We don't really need to go into the kind of rights and wrongs of PFI in the UK here, although happy to do so if anyone wants to ask questions. But the key point of it from an investment point of view, was it really kick-started focus on infrastructure as an asset class and sort of got people to refocus on it again. So the early stage assets in the UK were copied internationally, and investors began to realize that both government-backed infrastructure and other forms of infrastructure really had some high-quality facets to them, and critically were largely decorrelated from the shorter-term issues which affected more general equities. And I think that's most graphically shown in terms of the size of the infrastructure investment market and how it's grown over the last few years. So down in the left-hand corner, 2010, this is unlisted assets. So we had, around about 180 million of global investors' money invested into infrastructure assets, and here we are in 2022, up around 700, with a forecast for continued growth in that sector. So I think that probably shows, as well as anything else can do, how big this sector has got and how convinced very large investors, institutional investors, are now of infrastructure as a core part of their long-term investment portfolio. Now, as Richard said, my business is principally involved with listed infrastructure. So International Public Partnerships was a fund which I led the IPO of back in 2006, and it's now about a 3 billion market capitalization. And the listed sector has grown as well. And if you look at the listed infrastructure sector in the UK, you can invest across a whole range of different strategies: renewable power, energy efficiency, digital assets. Our focus is more towards the lower risk end of that spectrum, as I'll talk about in a minute. But I think it's important to recognise that the listed world has followed the unlisted investors in putting a lot of cash to work in this sector. And it therefore perhaps is worth just analysing some of the reasons why infrastructure has become such an interesting area for investors. And I think there are probably a longer list than this of attractive features, but these I think are some of the key ones certainly. And first and foremost is that infrastructure should generally have relatively inelastic demand. That's not always the case because I'm sure the first canal promoters thought that their canals would be used for centuries and centuries, and that wasn't proven to be the case. But most infrastructure assets, the assets you'll find in our portfolio, in most investors' portfolios, are going to have predictable demand characteristics. So some may be where you simply get paid money by the government for keeping the asset available. We've got a lot of those assets, so they're the safest ones. Others might be airports and ports, where certainly you'll see short-term variations in demand. COVID obviously had a big impact on airport investors. But generally speaking, people can make reasoned judgments about the future demand for those assets. So demand elasticity is a key part of the identification of a suitable infrastructure asset. Inflation protection really comes out of that demand elasticity because some infrastructure assets will have explicit inflation linkage. So again, these early PFI or PPP assets I spoke about came with a contract where the government agreed to increase the revenues every year in line with inflation. Other assets, airports, ports, are again good examples, may have an indirect linkage, but because they have a certain monopoly quality, you can expect that you have an ability to reprice and therefore keep your returns largely whole. So that inflation protection in infrastructure assets is sometimes explicit and is sometimes implicit. Obviously, where it's implicit, as an investor, you'd probably expect to get a higher overall return to take account of that slightly higher risk relating to demand. The duration of infrastructure assets is key. The classic infrastructure investor is a pension fund. That's not to say that only pension funds invest in infrastructure, but people are looking through the cycle. Generally speaking, people are looking to hold these assets for a long term, and therefore they are great assets for matching liabilities. They do fit very well into either institutional pension portfolios or people who are managing SIPs or other forms of self-invested pension scheme, or equally just people who want long duration income. that long-term nature of investment is again a key asset. Infrastructure is diversified. All those features I mentioned give rise to diversification qualities. Many of our investors now, obviously are focused on ESG type issues. So infrastructure is a classic, in my view, positive ESG asset class. Virtually all infrastructure assets are there contributing to the well-being of our communities one way or another. So I think infrastructure ticks a lot of boxes in that respect. And there's clearly often a desire, particularly with institutional investors, to have an explicit alignment in their investment policy with government and other public policies. So I'll touch on that again in a second. And then a stable cash yield, again, is what infrastructure assets also provide, because the returns tend to come out very, very predictably over the life of the asset. So all those are qualities which obviously are kind of relatively defensive in many respects. So I think infrastructure is often seen as a defensive asset, but when you look at the kind of charts that the previous speaker was putting up in terms of the drawdowns of this year, then I think actually the relative outperformance of infrastructure over the longer term can be quite surprisingly high. And infrastructure isn't simply a kind of backwards-looking asset class where you can say, I've got this asset, it's going to give me its return for the next 10 years, and everything's great. Infrastructure is a dynamic asset class, and I think this is what truly makes it, for me at least, an exciting one, and one which is worthy of continued investor focus. Because the future of our societies depends on new infrastructure, and the challenges we have today, whether they're demographics or climate change or decarbonisation, they all are going to contribute very, very significantly to the need for new infrastructure, whether it's electric vehicle charging, whether it's bigger sea defences, whether it's more homes for the elderly. All these trends are very, very significant in our world. So by focusing on infrastructure, it's not just about getting a long-term steady-state return with inflation linkage. It's actually also about identifying the future trends and the future areas where we need capex in our society to deliver the type of society that we want our kids and grandkids to live in. So I think that again is often overlooked in my view when people look at infrastructure. It's seen as a kind of relatively passive sector, but actually it's a lot more dynamic than people give it credit for. And so then coming back to something I mentioned a little bit earlier, if I'm convincing you at all and you look at infrastructure and you're interested by it, it's important to understand that all infrastructure is not the same. There's obviously a big difference between the type of infrastructure where you're taking full-on demand risk, building a canal and hoping people use it, all the way through to where you've got a contract with the government, they're going to pay you for 25 years just to keep a school or hospital or other asset available for use. So it's really important that when you do look at infrastructure and infrastructure funds, and it applies if you're looking at unlisted funds or listed funds, that people understand the kind of the key differences. And the key differences really do come down to the quality of revenue and the certainty you have around it. So the area that I tend to specialise in is this super core segment on the left there, public-private partnerships, regulated assets, where there's an established legal regulated system which gives you confidence that you're going to get paid in a very, very predictable way. So we own electricity distribution assets, we own gas distribution assets, we own water assets, as you'll see in a second. They all have this strong regulated quality to them, where a regulated settlement guarantees you this inflation linkage. And then you start moving up the risk curve because you've got assets like mobile phone masts or renewable energy, where in renewable energy obviously you're taking much more risk around power prices, for instance, and we'll come back to that in a second. Up to core plus, a bit more risk, car parks, motorway service centres, data centres, a good example here. And then, up at the end here, this is where sort of infrastructure can almost merge with sort of low risk private equity. You're talking about investing into future technologies. You might be investing into, rolling out broadband or fibre networks. So again, up here, less certainty about your asset revenues, a bit more kind of optimism required about the future of those sectors, but fundamentally based on some reasonably conservative assumptions, it's not much of a stretch for most people to say we need more fibre optic networks in our countries over the next 10, 15, 20 years. And this just brings out the point in a slightly different way, focusing directly on the inflation question. Public infrastructure assets, those civic assets tend to have this explicit link to inflation, and that certainly is where where international public partnerships started out. Economic infrastructure, ports, toll roads, has this hopefully kind of quasi-monopoly characteristic and therefore can reprice, so it's indirect. And then renewables, quite interesting in a sense, because renewables depend entirely on power prices. And right now, when power prices are going through a roof, obviously power prices are actually driving inflation, and those guys are doing very well. But I've been doing this for a while, and it was only, I think, 4 or 5 years ago that people were running conferences on, would electricity basically be free in the future, because there's going to be so much renewables, so much solar, so much wind, but actually the generation cost would be next to nothing. And at that time, those renewables funds had their revenues were actually tracking under inflation because the power price was going down, and that just shows how quickly times change in our sector. So the fundamental point in all these last couple of slides is you've got to understand the risk infrastructure. Not all infrastructure is the same. So what do we do? So Amber Infrastructure is a business that I co-founded, and we run a series of listed and unlisted infrastructure funds. We manage quite a lot of external capital, as Richard was saying earlier on, but we also are, I wouldn't say we're unique, but we're relatively unusual in using our own balance sheet, because we want to use our own balance sheet to try and identify the future infrastructure trends. And we use our own balance sheet to invest into early stage infrastructure assets, particularly in sort of new and more emergent technologies where we think they may become more mainstream in the future. So what I thought I'd do for the last few slides in this presentation was just perhaps talk to you a little bit, hopefully it's worthwhile, about one or two of the assets we've invested into in the past and why we did so, and also perhaps give you a flavour of some of the areas we're looking at in the future, but particularly with a kind of focus on inflation linkage, because we've always believed, not just over the last few months, but the last 20 years, that the inflation correlation is the kind of bedrock of what we do in the sector. So first example, and this is an asset class which is in our listed fund. So OFTOS are offshore transmission projects. So one of the great successes in the UK has been the building of wind farms around the coasts. In excess of 20% of the nation's electricity comes from wind when the wind is blowing satisfactorily, and those wind farms are linked to the onshore national grid by electricity transmission cables, obviously. What people may not realise is that under the UK's regulatory regime, the transmission cables are not owned by the people generating the electricity out at sea. They're owned by different owners, and we were one of the pioneers in actually owning and investing into this asset class. And the reason we were pioneers into that asset class was we were aware of the legal prohibition for generators owning these cables, and we certainly weren't the only people, but we were involved with Ofgem, the UK energy regulator, in devising the regulatory regime for these assets. And what particularly attracted us to them was a regulatory regime which had explicit RPI linkage, and where that regulatory regime was fixed for an initial 20-year period. So we bid these things, we own these things, we maintain these things, and we receive revenue from these things, which is linked to inflation. And unlike other regulated assets, there's no review of the return we make on those assets for the first 20 years of their life. So these have been great drivers of inflation linkage in our fund, and we've invested in, I think, 9 of these things so far. We're 23 around the UK. And there's a whole host more which are in development, and obviously we'd like to think we might win our fair share of those in the future. So I think this is a good example of an infrastructure asset class where we got in at the ground floor. We took risk onto Amber's balance sheet initially around that. proved the investment concept to our satisfaction, and then exposed our investors in our listed fund to that asset class with good results so far. Very different asset. This is a picture of the Royal Children's Hospital in Melbourne, Australia. So, you might think it's got absolutely nothing to do with electricity transmission, and you'd be right in one sense. In all practical senses, you'd be absolutely right. But where it has similarities is in terms of its investment dynamics, because here we built this hospital, which is, to be honest, slightly more attractive than it looks in that picture. It was a significant construction project, replacing a sort of clapped out old hospital there. Our obligation was to build it to the government's standards. Once we'd built it to their standards, they give us a guaranteed revenue with inflation linkage for a 25-year period. Our obligation is to maintain it to the standards required in our contract. So we've got a maintenance obligation, but again, we're not taking any risks around how many patients in a hospital at all. So again, from our point of view, looking at it purely from a financial point of view, we've got a long duration revenue stream with indexation attached to it. It's not quite like a bond, because we do have to do this maintenance, and obviously we employ people to do that. We subcontract that to large-scale facilities management companies. So it's not like a bond. We do have those added obligations, but equally we're getting a return on these assets of, let's say 7-8%, and obviously that contrasts very favourably with the return on say debt issued by a body of similar credit quality. Back to London, this is another asset which is owned by INPP. You've probably seen it, you might not have noticed it, but under the river in London and just down by Blackfriars Bridge, it's a big construction site, there's a massive civil engineering project going on. It's a gigantic sewer. No one said our work was glamorous. So it's a gigantic sewer. It's the size, so it's bigger than a sort of double-deck bus in terms of diameter. And it's designed to alleviate a problem which has been growing in London over the last 100 or so years, which is that when it rains in London, which it did last night, I noticed, the current existing Victorian sewage system overflows. So it was designed in that way, but basically all the people living in London now, together with rainfall, the sewers overflow, and by design, the overflow goes into the river. So raw sewage would have been washed into the river last night, and that's why people say you shouldn't go paddling in the Thames, not in London at least. So the answer to that is this gigantic sewer, which is going to be, or is now, because it's largely complete, some 25 kilometres in length, goes from West London all the way down to East London. And so when the sewers overflow now, the overflows will be diverted. So they don't go into the river, they go into this tunnel. And this tunnel will reach all the way down to London's biggest sewage works at Beckton in East London, where it'll be pumped out and the sewage treated. And the net result will be that the Thames in London will be materially cleaner, and the 100 or so sewage spills into the river in London every year will cease. Maybe that's interesting, maybe not. But again, from a financial point of view, it's an asset which does something very, very good and predictable for us. It's a long duration asset. It should last 100 plus years. It's a regulated asset. Again, we've got a very long period before the first regulatory review comes through, so we're allowed to make a permitted return on the capital of that project for that period, and that permitted return is a real return. It's explicitly inflation linked. We were involved in the very beginning of this project. We spent 5 years working on the kind of development of it with various people, and it will be completed probably in 2025 now. So it shows how long and how patient you have to be in the infrastructure sector. But if you are, you can invest in some really, really high quality assets. Changing a tone slightly, newer asset. One that's not in international partnerships, one that's probably not suitable for international partnerships currently, one that's on Amber's balance sheet. Here we're using our own money in Amber to develop a grid-scale battery storage facility up in northwest England. This is a joint venture with Tesla. So this will be a 50 megawatt, 2-hour battery, so it can produce 50 megawatts for 2 hours. And this is a purely merchant generation facility. So basically, this battery will operate its battery, so we'll try and fill it up with electricity when electricity is cheap, and we'll try and discharge it when electricity is expensive. And it's not quite as simple as that. You don't fill it all the way up and then decide to discharge it. In reality, you're going to be filling it up, discharging it probably on, as little, every minute or even 30 seconds at times. So the way these batteries make money is they effectively arbitrage the electricity system. So when electricity is cheaper, you're taking electricity in. When electricity is more expensive, you are discharging it. And so our revenues here will be merchant. So they depend on power prices and particularly depend on the arbitrage between power prices at different times of the day. That's why it's not an established technology as yet. There are one or two listed battery funds out there, but I think they all have this inherent kind of slightly unproven nature of their revenues at the moment. So in our view, this is a sort of asset that sits in a higher risk pool of capital until it's proven. I wouldn't be at all surprised to find in 5 or 6 years' time this is a mainstream asset class, but we're not there yet. But again, we would expect there'd be indirect inflation linkage here because ultimately we see a parallel between inflation rates and power prices. And then just to sort of focus a little bit more briefly on other areas which we think are kind of interesting areas for the longer term. Data centers, I think, again, are quite interesting. They're not in the super core space because they don't necessarily benefit from assured revenues. But the continued growth of cloud computing has meant that data centers, are remaining short supply, and I think there's every likelihood that will continue to be the case. So we're involved in data center development both in Australia and in the Baltic states. Batteries we've kind of talked about. Supported living, that trespasses a little bit on into kind of real estate rather than infrastructure, you might say, but the demographic kind of time bomb, aging populations, unsuitability of much existing older accommodation, to extent also climate change, because much existing accommodation for elderly people is wholly kind of not fit to meet current building standards and so on, with kind of regard to U values and insulation. So I think supported living is a really interesting area to be focused on. And then I think renewables, still interesting, particularly in the US. Our US business is very active in renewables at the moment. Obviously, the US has lagged behind a little bit in some respects, but I think it's catching up very quickly, particularly with the new legislation from Biden. And then I think, lastly, I've highlighted one particular transmission scheme in the US there, but transmission is often overlooked. Everyone talks about generation, everyone understands generation, but the kind of knitting that goes with generation or changing generation patterns often isn't really thought about so much, and actually the predictable returns often come through things like transmission and distribution rather than generation. So what's it all meant? I mean, what do we deliver for our investors over the last few years? So I mean, it's one thing to stand up here and kind of get passionate about the asset class and the future of it. This is obviously historic data, and most of this historic data really predates the kind of inflation spike that we're going through now, and this obviously relates to our listed fund. But we've got a lowish correlation to general equities. You see that in the bottom left-hand corner. That I think supports the kind of sort of diversification argument. We've got a significant inflation correlation. We never claimed it to be 100%. It's not all assets inflate, and not all of our assets inflate at the same time. So it's not the same as a index-linked treasury bond or gilt, but that inflation linkage does come through and will come through in both dividend and in NAV. And we've given a pretty healthy return to investors over the last 15 years or so, average 8.1% return since 2006. So I think that the asset class is proven, and I think that other funds in the sector, to be fair to them, many of them would give not dissimilar historic performance data points to you. So I was asked to sum up some conclusions and takeaways. So I've sort of tried to do that there. I think that the sector I specialise in is, I think, fully established. I think it offers a scale and diversity, in my view, that historically real estate and private equity have done, and I think it needs to be recognised as such. I think it's seen substantial growth, but the story isn't over. There's a lot more growth to come. There's a lot more infrastructure that our societies need. Public sector capital is going to be insufficient. We're borrowing another 100 billion today in the UK to fund some bailout for fuel prices. There are going to be limits on the capacity of public sector balance sheets to finance the new infrastructure we need. So I think there's going to be plenty of opportunity for private capital to play a role. The inflation linkage is key. We've got case studies which I think have demonstrated the historic linkage and hopefully give some clue as to the kind of the opportunity set going forward. And I think we've got that kind of proven low level of volatility. So I think I've run out of time. I hope that's been interesting to you in terms of really kind of brief canter through what I think is still a relatively under-recognised sector, particularly amongst the kind of, away from the very largest international pension funds. But I hope also mostly that I've communicated some of my enthusiasm for the asset class, and that I've convinced some of you that it's something you should take a closer look at. So thank you very much indeed.